whether they have the ability to trade with certain dealers, or whether they have a certain relationship with certain dealers. Because at the end of the day, it's one of the things about derivatives that I think is often never mentioned or often misunderstood, is that derivatives aren't just traded between entities just because they feel like it. Derivatives are traded between entities generally based on credit decisions. And I can explain that a bit better. I am not going to buy protection from counterparty, from a dealer, unless I believe that dealer is going to be able to pay me out. Case, let's say I want to buy protection on IBM. I'm not going to buy protection from J.P. Morgan unless I really believe J.P. Morgan's going to be able to pay me out when IBM goes bust. Vice versa, J.P. Morgan, in determining who they trade credit derivatives with, is going to make decisions on how strong, how credit-worthy their counterparty is. So let's say I'm an insurance company and I want to sell protection on IBM. In other words, I want to receive the premium from J.P. Morgan on IBM. J.P. Morgan will make a price for me on that, will buy protection from me, but they will only do that if they believe that in the case that IBM goes bust, I can actually pay them some money. And so J.P. Morgan will not just deal with any counterparty when they trade derivatives. They will make sure that the counterparty they're dealing with is a strong enough counterparty. And if they don't believe the counterparty they're dealing with is strong enough, they will require that counterparty to put up some collateral. J.P. Morgan will not deal with any counterparty, and this is the case for any bank, any dealer of derivatives. They will not deal with anybody in derivatives unless those counterparties are prepared to put up collateral. And not just today. Let's say they believe they're good enough credit today. Say they're dealing with a AAA counterparty, and they say, okay, well, we like this counterparty. We don't require them to put up collateral. However, in the future, you will sign an agreement. If you deteriorate, let's say you're no longer AAA, you become AA, you will have to put up some collateral.
But a lot of agencies have gone bust in the last 6 years, like Bear Stearns and other agencies. And why, for example, today, in your view, in the New York Times, is there an entire article on credit default swaps and how they should be regulated and how they're weapons of mass destruction and all of the finger pointing now when, for example, last year I saw a conversation between Alan Grayson in Florida and Mr. Paulson at the Federal Reserve. And Alan Grayson had said, can you please tell us where the $700 billion went for the bailout? And Paulson said, I can't answer that. And he said, what do you mean you can't answer that? And he says, I don't know. It went into credit default swaps. Anyway, there was more conversation that was had about that. You know, where did you get the right to do that? You gave us that right with the Federal Reserve Act. But for a lot of people, for example, who thought that the bailout was supposed to go to bail out individuals and it was going to these credit default swaps, and then it brought a lot of concern from the public. Why is it going to this thing, and what is this mystery thing called a credit default swap? So I'm sure you can understand why there was a lot of upset about this. And part of it was the mystery, but part of it was that the public was under the impression, and so were many people in Congress and in the Senate and governors and elected leaders and elected public servants, that that bailout money was going for something different, and it wasn't. So that's a separate matter, but the credit default swap was part of the conversation that was had. So I just wondered if you had heard about that and if you knew that.
I hadn't heard about that, and I would struggle to try and explain what he was talking about. Betsy, I don't know. Are you more familiar with that?
Yeah, and unfortunately, I think you're referring to. Are you referring to Hank Paulson's testimony?
Right.
Congress. Okay. Like I said, I did not. I've read about that testimony, and ultimately, I believe what the crux of that overarching argument is that, from Mr. Paulson's perspective is that $700 billion went into stimulus, and I think, unfortunately, what the tidbit of information that came out of that sort of conversation was the term credit default swap, which everyone started to focus on. Obviously, stimulus went to a lot of these housing plans, went to a lot of thought process on how to stimulate job growth, et cetera. So $700 billion didn't all go to credit default swaps, but I think there was probably a perception that just because the credit default swap term was used, it caused there to be a lot of concern that maybe too much of this or a portion of this went to the bailout of these institutions. And primarily it was based around AIG and what Terry referred to as the collateral or the requirement that AIG, as it became a less credit-worthy entity, as the rating agencies downgraded them, their counterparties across the street or Wall Street, from your Goldmans to your JP Morgans to your other institutions who had contracts on with them, per their pre-agreed agreements, had determined what would be required that AIG would be required to post in the instance that they became less creditworthy. And in those instances, as Terry also mentioned, their assets or their ability to pay those requirements became less and less capable of doing so, and ultimately got to a point where every institution was calling for their collateral, and AIG really threw its hands up and said, I do not have enough capital assets to actually meet these requirements or these margin calls. And in that instance, that really became the conversation with Paulson and the Fed of what actually needed to be done, and, you know, the quote-unquote AIG is too big to fail, where the federal government actually stepped in and basically loaned them capital in order to meet these requirements. And the crux of, I think, what the comments that you're referring to were getting to was why, and Goldman's hypothetically always sanctioned in all articles, you know, why does, Goldman get, say, a $12 billion payout from AIG based on this loan that the government has given them? And that's because AIG was required under their terms of all of their derivative contracts to pay certain amounts of collateral if the worst should happen, and it did. And then I think that negative sentiment really just made, the market, press think that it was a credit derivative fault that AIG went bust. So I think a little disclosure or sort of background to that is just really understanding that AIG had gotten involved in a lot of assets that they potentially should not have gotten involved in, but sort of everything that was pre-agreed and laid out was needed to be followed in order to make sure that their counterparties were maintaining their own capital adequacy against the trades that they had. And unfortunately, when everything in the markets were going badly and prices were coming down, that caused AIG to be required to pay out lots to their counterparties who they had agreed to do all these trades with.
Okay.
So that's a little bit of the dynamic of why that happened, and I do understand why there's negative sentiment around there, but it's not the credit derivative fault. It's the fact that the value of that credit derivative or structured product or whatever was against that had gone down, and maybe AIG didn't know what they were doing, or maybe they did, and unfortunately it worked against them, but that's the crux of the argument against credit default swaps. And right. Again, so I'm not trying to say they're good or bad, it's just what was happening at that time, which is why there's always negative sentiment against them.
Okay, thank you for that. I'd like to invite Ellen Brown, the author of Web of Debt, who has been listening in on our interview and who I interviewed several months ago. Ellen, are you there?
I'm here.
Thank you for being here, and I'd like you to feel free to ask Terry and Betsy any questions or to share whatever's come to you to talk with them about.
Hi, thank you very much for your discussion. It is an obscure subject. I had a particular question about, I read that Los Angeles is on the hook for, let's see, 29 million for a credit default swap on its bonds, I guess on the interest rate on its bonds, and then Ben Bernanke, it went along swimmingly as long as interest rates were doing the normal thing. But then all of a sudden, because of the Wall Street mess, Ben Bernanke lowered interest rates to almost zero. so that meant that LA